brought to you by IG, and I want to dive right into this because we have our friend Paul Capetta here, and it's a really interesting time to be talking about forex, especially from the U.S. perspective. Paul, first of all, how you doing, my friend?
Good. How are you, friend?
Fantastic. I'm glad to have you here because it seems like, we've been here a couple of times in the last 2 or 3 years, and if I reference that time frame throughout this segment, it's because the last 2 or 3 years have been way different than the last decade previous in the forex trading space, and it's because we've seen such unprecedented U.S. dollar strength. And today, it feels like we're in one of these modes that we've only seen 2 or 3 times in the last couple of years, and very short-lived, usually only lasting a couple of weeks. And that's why everybody's wondering, is this the final sustained jump where the U.S. is showing some weakness, Paul? And I'm really interested to get your take as we dissect this story a little further. Does this feel like the U.S. dollar could give background all the way to, in terms of euro 120, 130, what's been historically, when you broaden out that lens, very normal for euro dollar, and pound, 150, 160, what's been normal for the last couple of decades versus the last couple of years, where those normal prices have been more respectively 105, 110 for the euro and 120 for the pound. It feels like we're in that inflection point, but it could also be one of those short-lived flashes in the pan that we've seen a couple of times recently. What's your general pulse before we dive into it on this U.S. dollar story?
Yeah, sure. I mean, so for the last probably month, 2 months, we've kind of seen inflation expectations really kind of pare back. Expectations there. We're not seeing like the kind of inflation we saw last year, which means the Fed doesn't have to do as much with raising interest rates. And there's, as you said earlier, there's a chance that we might get a rate cut in March now, which is way earlier than we were predicting even in the summer of this year. So that's kind of paring back some of that dollar strength right now. But we're also seeing today, on the flip side of things, you're also seeing inflation kind of dip down in Europe as well, which is why you saw basically the European currency, so the euro, move more than the rest of kind of the majors today. So that was a bit interesting. But basically, you've seen, the 10-year go from 5% basically to, I think we're at 4 3/10 today. So that's quite a big move in that, and that's why you're seeing kind of the weakness in the dollar there. Doesn't necessarily have to hold either. It can revert back if interest rates start to tick up again.
Yeah, absolutely. And we're going to dive so far into that interest rate piece. So everybody strap in. It's going to be an interesting one here as we get you ready for it's so thankful to be in this time, because for so many years, for that decade previous to the last couple of years here, it was 0% interest rates globally, and there was no story to tell. And yeah, right now there is so much nuance, so much going on in these markets because there's a constant struggle of relative strength in that interest rate market. But here's where we've been, and here's where we are now. And using the UK as a backdrop against the US here today, because UK has been kind of the most competitive, UK and Euro area, the last couple of months here, and actually mostly throughout the last couple of years, they've been, relatively speaking, the next strongest to the U.S., but especially this pound piece. But it did get down to 105, Paul, and that was the highs for a dollar. You'll remember in the fall of 2022, that was when dollar ran up huge against yen. Euro got down to under parity for a handful of days, not just a quick flash, as the pound story was a little bit more short-lived, but we're pretty far from that here at 126. A 2,000 pip rally back for that pound leaves the dollar seemingly a little bit vulnerable here, or at least headed in the wrong direction for the majority of 2023, and potentially closing the year near its lows against the pound.
Yeah, definitely. And you've seen the Bank of England do a lot with interest rates as they're tackling their own inflation. If you're thinking about England's economy, they're going to have to import a lot of goods, so they're going to be more hit by inflation that way. So the central banks only can use their only tool in their bag for that is raising rates. So that's why you see some of this kind of resurgence in the pound. And their economy is kind of held up well, so they can keep doing that. In the Eurozone, their economy is getting a little bit on the shaky side at this point where they can't do as much. So the pound kind of rallying back to more historical levels. We're still actually at least 1,000 to 1,500 points from historical levels. So we're by no means a strong pound at this point historically. So it's an interesting one. It's definitely seen the Bank of England really drove this thing higher, basically out throughout the year.
Yeah, absolutely. And just to elaborate a little bit further on that before getting to that historical level with the pound, because if you've been trading the last couple of years, very different environment, and you might be shocked by what was seen the previous decade there for that pound. But how we got to this point, which was, a pound at $1 and a nickel, a euro to dollar market under $1, which was huge, unseen in 20 years, was higher rates in the U.S. And of course, it was higher across the board with the exception of Japan, but it was just stronger, faster for the U.S. And maybe you can illuminate a little bit of this story, because not only it wasn't like, Paul, 2 years ago, there was no inflation and 0% interest rates, and then today we woke up and we got here. But especially in the fall of 2022, when we reached those highs for U.S. dollar, that was when the U.S. had really distanced itself from the U.K. and Canada and Euro area and was threatening to have to really widen that gap even further. Whereas now, we're 25 basis points higher than the UK and 100 basis points higher than the Euro area. Maybe you can flesh out this story a little bit, whereby everyone went higher, but the US kind of won that journey throughout and still is the highest.
Yes, it was the aggressiveness that the Fed took and the pace of rate hikes that they did last year is really what got us to those kind of extremes there. They were moving, I think they moved 75 basis points in one of the meetings. It was kind of extraordinary times. It's not something you'd see historically as the Fed moving that much. Now they have done more than 100 basis point cuts before. So it's not unheard of, but they were moving at a very quick pace, and the rest of the world basically wasn't. They were moving at a more slower pace because, again, when you do rate hikes, you are trying to kind of push the brakes on the economy, and if you push the brakes too hard, you're going to come to a complete stop. So that's what a lot of central banks around the world were worried about, is totally freezing out their economy and slowing it down basically into the recession. So the U.S. didn't see that. We didn't really have basically that kind of demand crush that rate hikes can bring. So we kept on going, and the Fed basically kept their foot on the accelerator with the rate hikes, almost basically pressing down the brake as much as they can, but we weren't slowing down the fast-moving car that is the U.S. economy, basically.
Yeah, and I'm glad that you helped to illuminate that nuance there, because, again, if you just saw this, you would think like, oh, so then the dollar maybe appreciated slightly against the pound, right? And it's like, no, man, like we're still in pretty high territory for dollar, low for pound, because it has a lot to do with what's been going on the last couple of weeks. Because the question then becomes, okay, well, if that's the painting, that's the story there, the global interest rate story, then why the hell is pound rallying 500 pips against the dollar? Why are we pushing on not only 125, but potentially getting back to 130, the highs thereabout for the last couple of years here in the pound market, if nothing's changed? And it's that same type of nuance, once again, where the U.S. was the most aggressive to the upside and now going to potentially be the most, whatever you want to say, elastic or aggressive to the downside. Because I'm gonna let you talk about this one, because I thought this was really interesting. Looking at the price action for not overnight rates, because central banks move overnight rates just a handful of times. They have the opportunity to move them a handful of times annually. But bond markets are moving every day that markets are open. And so you look at this price action the last month. Now, the U.S. still, in terms of the 10-year, which is pretty much the benchmark for yields globally, we're still higher than most of the world in terms of major economies, Paul. But you look at that 1 month price action here, and that pretty much tells you all you need to know about the pound's recent resurgence and the dollar's loss of relative strength.
Yeah, you saw basically the aggressiveness, the aggressive move in rates in the 10-year really kind of exasperated in the U.S. and not so much elsewhere, which is, again, that's going to lead to U.S. dollar weakness. And this is straight interest rate differential move. Is basically the U.S. interest rates coming down quicker than basically the rest of the world, as opposed to last year where the U.S. interest rates were moving up quicker than the rest of the world. So it's just that kind of paradigm that's happening on the flip side of things. And again, this doesn't mean that it has to continue like this. It can flip around if U.S. interest rates start ticking up. I mean, the inflation we got today was on par with estimates, but it's still above 3% basically. And again, the Fed's target is 2%. So, and they've been pretty adamant that they are going to be hold monetary policy steady until they get it to 2%. So.
Yeah, and you're exactly right that elasticity, or let's just call it volatility, works both ways. Yeah. Like if we're looking at this again 1 month from now, and the 10-year has rallied back 100 basis points, and British debt, German debt, French debt, everybody has only rallied back 50 basis points, then that dollar might be pressing on its highs once again. But this has been the recent trend, and a big reason for why the dollar has moved towards its lows is a little bit of a precursor of what could come, which is the United States Central Bank, the Fed, moving its highest overnight rate here of the global bunch more into the mid-tier. That would be cause likely for a lot of relative weakness in that U.S. dollar. And I mean, you know this better than anyone here, Paul, having looked at this stuff for years, the fact that not only can we get back to 130 where we've been here on the year, or even, oh man, God forbid, 140 where we were at a couple of years ago. I mean, this is a market that you travel back 5-10 years and it doesn't really even touch 140 to the downside. Why don't you talk a little bit about this history between the pound and the dollar?
Yeah, so, I mean, we're calling 210, that's probably one of the outliers kind of on the chart, but getting into that 140 to 160 range is where it sits historically. But yeah, no, if you see any sort of kind of weakness in the U.S. and where we see a Fed that's gone totally away from rate hikes and rate pauses to rate cuts and aggressive cuts, then you can see this thing start to move in the opposite direction rather quickly. Obviously, the 08 kind of spike there is, I believe, when the U.S. started to cut rates towards the end of 07. And then you see the kind of resulting change of the basically global financial system going straight risk off, which is where the dollar rallies all that much. It's quite a significant rally there in about half a year there. But yeah, you can definitely see kind of what can happen, and especially in this one where this thing can get volatile out of nowhere, basically.
Yeah, absolutely. I mean, yeah, of course, not even factoring in the elephant in the room that if something unforeseen happens to the economy, what does that look like? Is that, really violent reversion to the mean, to the upside, swings back and forth like we have seen in volatile periods for the stock market? Like we always say, forex very uncorrelated to the stock market, but volatility across asset classes tends to be very correlated. But that aside, if we do see this current trend continue further, which is, U.S. was the strongest to the upside in rates and now is potentially the weakest to the downside, I mean, you could easily see an environment of getting back to 130, 140, and even going prior to 2015 prices where, to your point, 140 to 160 was kind of like the average, let alone some of those outliers in the 90s and the mid to late aughts that were at 2 to 1 at certain periods. Now, just to finish up here, what could send rates lower, kind of send this U.S. dollar into an even further potential spiral? Well, as you might expect, it's anything that indicates U.S. strength lessening even more, just U.S. weakness in general. And that means, lower than expected inflation numbers, lower than expected employment numbers, which could even be more detrimental, not only to these markets we're talking about, but that stock market as well. And then that elephant in the room, the stock market crash. I mean, out of all of these things, what are you watching moving forward? Is it a specific economic data point? Is it the inflation side versus the employment side? What do you think will set the course for interest rates, the path moving forward here?
Yeah, I could use the cop-out answer in all of them because you kind of need to look at all of them. The stock market crash is kind of the outlier where it's going to send yields lower, everything goes risk off, and people buy 10 years. That's typically what happens. But, I mean, we've got so much ground on inflation. We've brought inflation down so much that I think you're going to see less movement there. It's going to be the employment picture moving forward, and I've said this a few times here over the last few months. It's if that employment piece changes, if we no longer see a strong job market, things are going to change as far as what the Fed's going to do, and they're going to have some decisions to make. The worst case scenario is if you have inflation still high and unemployment starting to tick up, basically. That's the worst case scenario. But those are probably, employment will be my pick as far as what I'm going to be looking at in the first quarter of 2024, just because that hasn't really changed. So I'm kind of expecting something to give there. It doesn't necessarily have to happen. Employment can stay low and we can get the soft landing the Fed's been talking about.
And to your earlier point, that's where we could see that resurgence before an inflation turnaround potentially if it goes in the opposite direction.
Yep.
But either way, you're seeing so much dollar weakness recently for all these different reasons. We'll continue to monitor. But Paul, thanks so much